From job site to boardroom, Trades Talk is the voice of the next generation trades. Hosted by Justin White, this show is your weekly dose of real talk, motivation, and strategy from the disruptors raising the bar in the trades. If you're building, scaling, or leading, this is your playbook. Welcome to Trades Talk.
Hey friends, welcome back to another episode of Trades Talk. I'm your host, Justin White, and today we're going into mergers, acquisitions, access to capital, value creation, specifically within the landscape industry. I have in studio Jeff Harkness today. So here's the deal, guys. I recorded this with Jeff about 6 months ago, maybe a little bit longer, for the Disruptors community. And for the last 6 to 7 months here, the Disruptors have had access to this incredible multi-module learning path that Jeff helped teach. And one of the Disruptor members reached out recently and said, hey, this multi-module recording with Jeff Harkness is an absolute game changer for how I look, I grow, and I build my business. And mentioned it'd be great to share some of this with the world. And I kind of was thinking about this, and, part of the Disruptors is creating this exclusive group that is focused around building eight-figure businesses. But I am creating so much amazing content in there, I just can't keep it behind locked and key for that long. And so I figured I'm going to take the first of what are 3 modules of this training course and make it available here on Trades Talk. I think this is incredible information from Jeff Harkness with 3PG Advisors, and I just felt obligated to share it with the world. So that is what the show is going to be today. It's a recording that Jeff and I did a number of months ago, specifically for the Disruptors, so you may hear some of that within the show, mentioning the Disruptors, but overall, the talk is going to cover a few main points. So while it's the first of 3 modules and the other 2 are going to remain inside the Disruptors, we go a little bit deeper and we talk about some confidential stuff that really does need to remain in the Disruptors. But what you're going to hear in this intro is about a 40-minute conversation with Jeff and I. We talk about private equity at a deep level. How does it work? How do they create these private equity firms and these funds? We talk about the value creation playbook and where growth comes from, the top 3 that you need to know to build a valuable business. We talk about the mindset shift that you need to have to take your business to 8 figures and beyond. We also cover all types of different sources of capital and access to different capital. And that's one of my favorite things we talk about, is really pulling the veil back behind this idea of capital and where to get capital, mezzanine debt, private equity, private investments, the banking traditional route, SBA. Jeff unpacks all of this for us. So you're going to hear just an amazing, deep, educational level information about the buy and build strategy, the current mergers and acquisition world. And keep in mind, this is just speeding up in 2025. Deals are flowing like crazy right now. And so I thought it was only timely to drop this episode for you guys. I sincerely hope you enjoy. If you have any questions, comments, drop them down below on Spotify, YouTube, Apple Podcasts. Send me a DM on LinkedIn or Instagram, or just email me, justin@jwhitegroup.com. Would love to hear from you guys and appreciate everyone who does reach out. Let's keep it moving and let's keep the community going. If you want to check out the Disruptors community, of course, go to jwhitegroup.com. Check it out. We have a 7-day free trial where you can get access to this course and many, many, many more. I just wanted to bring this out to the world. Hope you guys enjoy. All right, let's hit it. Hey, Disruptors, welcome, man. We are so excited for this module. I've got Jeff Harkness from 3PG Advisors here, and we're going to cover some really important data, some really exciting topics that I know you guys are interested in hearing about. So, Jeff, welcome in.
Thank you.
Why don't you tell the Disruptors a little bit about yourself and what does 3PG do?
Yeah, thanks. First of all, good to be together. Thanks for having me, and excited to be here talking about a lot of fun stuff. And so Jeff Harkness, as you said, we're located down in Atlanta, and I'm the CEO and founder of a firm I started 28 years ago. And I grew up on a dairy farm in upstate New York. When I moved to Atlanta, I was fortunate enough to get hooked up with some good business guys that knew mergers and acquisitions. And we were taught and believed that niche market matters. If you're going to be successful in business, particularly in finance and M&A, you need to be known as an industry expert. And so we've been on just an unbelievable run for the past, seems like, 10 years. It's been crazy with what's been happening in the industry. And we're working mostly in Canada and all over the country. We've done a little bit of snow and ice in London, England. And we're working with founders or entrepreneurs, tree care, turf care, landscaping, residential, commercial, snow and ice. And we work with those CEOs and founders, and we help them grow and scale a business to a point at which they say, hey, I'm ready to bring on a partner, which could be a private equity investor. I'm ready to transition with a strategic buyer and move towards retirement. And so what's been fun for me, I'm 53, okay? The wealth that's been created in the industry that you and I call the green industry,
Right.
We've seen it be transformational for founders, owners, their families, key employees. And a lot of times people don't believe it. And we've had a front row seat. It's been super cool.
What an incredible journey our industry is on right now. And I think this topic is probably the one that has the most curiosity about it, because inherently people can't talk about certain things because of NDAs and confidentiality. And it's not as easy to talk about M&As and selling and buying companies as it is about software or equipment. So this seems to be one of those conversations that happens kind of in the corners of the conference, or you see the guys outside in their circle meeting very quietly. So I asked Jeff to come on today, guys, and really throughout the next few modules, we're going to be unpacking a lot of these myths and demystifying things and opening up these opportunities that are in the green industry to create significant wealth. So with that, why don't we jump into our first module, which is going to be access to capital and growth.
Yep. Sounds great. So let's start with OG.
Yeah.
Right. Old school, original, right? Any old school, right? And so if you think about traditional business and over the past 30, 40, 50 years, the life of the entrepreneur, most folks start as technicians. I'm a plumber. I'm an HVAC tech. I like to cut grass. I have a passion for landscape architecture, whatever it may be. We start as a technician and then one day say, hey, I think I should start a company. Let's get into business, right? And then you get out there, and the traditional path for the entrepreneur is one customer at a time, one employee at a time. And over your life's work of 20, 30, 40, 50 years, whatever it may be, you grow a business to a certain size and scale, and then you decide that you're going to exit. I'm going to retire. And when I came up as a young guy, sometimes I'm done meant I'm closing the doors. I'm going to sell my trucks and equipment. Maybe I've done some real estate. I got a tree farm, and I got other passions, but I'm just closing the door.
Right.
Right. And so as things have really progressed in the industry, now there's been these other options of, hey, I've created some size and scale. I'm ready to do something next. And as you're going through that entrepreneur type process, you need people, you need process and procedures, but you need capital, right? And kind of that old school mindset was always this: I'm going to go down, I'm going to develop a relationship with a traditional bank. I'm from Atlanta, so I'll use Truist because that's the name of the Atlanta Braves sponsor at the baseball field.
Okay.
So Truist Bank is a traditional bank, and they do SBA loans. They also do conventional loans. So you come down and see me, I'm the Truist banker, right? And you say to me what? hey, I need some capital for trucks and equipment. I need some capital to buy, to have a line of credit. I need some capital, Harkness, to go do some acquisitions. And me being the truest bank or the traditional banker, right, as an example, here's what I'm going to do. I'm going to say to you, no problem, Justin. Let me look at a few things. The first thing that I want to look at is I'm going to check your credit. What's your credit score like? And are you a credit score of 700 to 800? But I'm going to check your credit out, right? And I got to check that box because I got to go in front of a loan committee, right? Or some type of process, but I'm going to check your credit. The second thing that I'm going to do is I'm going to say to you, hey, prove to me when I look at you personally and from a business perspective with the debt that you have in place, prove to me that you can continue to cash flow. If you're asking me for $1 million and you have some debt already, I want you to prove to me that with your sales model and your profitability that you can cash flow the loan, right, that you're asking me for.
And they're going to call that typically debt service
correct
coverage ratio or along those
exactly. And most traditional bankers, if I make 100,000, if I'm asking for 100,000, if I have $100,000 of profit, okay, or better yet, let's think bigger.
Okay, yeah,
okay? $1 million,
right?
Okay, you want $1 million, and I'm going to come in and I'm going to say, look, I'm going to add up and look at your debt service, and if you're asking me for $1 million. And I need roughly, that's $100,000 a year in payments of principal and interest. Okay. I'm going to look at your business and say, I want to make sure that there's at least X number of dollars in profit that the business is generating. And that ratio is typically for every dollar of profit, $1.5 of profit and cash flow. Excuse me. For every every dollar of debt, $1.5 of profit to cash flow. Right.
Right.
So you're in my office. Right. And we're looking at your credit. You're proving to me that you can cash flow the debt. And then the third, and there's really four, the third is really important. And that is, I say, look, if for some reason you go out of business and I need to come claw back the money that I've loaned you, okay?
Right.
What stuff do you own that I can come take back? Can I take your trucks and equipment? Do you own some real estate? Do you have some money stored away? Collateral, right? And in the traditional bank lending world, collateral matters. And oftentimes it's the biggest limitation to lending you money. It's like, you don't have enough collateral for me to loan you $2 million. Okay.
And do they want to see that a lot of times as a personal guarantee to your personal assets?
100%. So,
right.
As you grow and scale, when you grow and scale a business, the older that you get, I'm pointing to myself, the older that you get, typically I'm less risk adverse, right? And if I'm less risk adverse and my business still needs capital and I'm not willing to stick my neck out and bring more capital in, you lose your best people because they're like, well, where am I going with my career? So cash flow, credit, collateral. And then the last is I got to believe that you know what you're doing.
Right.
Right. Like, hey, I believe that if I loan you money that you can go out and perform. And so if we go back to that traditional entrepreneurial world, right, I'm going to come to a traditional bank and I'm going to ask for capital. And a lot of times you don't have enough collateral for me to loan you the money. A lot of times a traditional bank says, man, I really like doctors and dentists and engineers, but I don't love landscape contractors. Okay. I'm worried about, the sustainability of profit. So in our world, if I'm a old school traditional entrepreneur that's growing a landscape company, a lot of times the only knowledge that I have to capital is that traditional banker.
Right.
Right. And that creates limits in our ability to grow and scale a business. Because I'm here to tell you, if you don't have enough collateral, we're going to go do an SBA loan. And I'm for SBA loans. Okay. But you also got to step back and say, how difficult is that? And typically, if SBA is involved, when you get into buying companies, there's lower valuations, limitations on how much they're going to lend you. Right.
And you got to make that up with
you
cash.
Do. So the old school traditional way is traditional banker. Right. Now let's fast forward, right? Because it's been a good run.
Yeah.
Good stuff going on. Let's talk about other sources of capital. Okay. The second source of capital, I don't know if there's people in the audience that have it, but if you got a rich uncle, a rich aunt, or wealthy parents, right? And they're saying, hey, here's $3-4 million bucks. Go build your business and your dream. But there's not many of them out there. Certainly it wasn't the way I came up and not the way you came.
Definitely not.
Right? So, we kind of chuckle at that rich uncle, but it does bring into play this concept of private investor. There are very successful people in business that have scaled to a certain amount of wealth, and they do in that private debt world loan money, in that private investment world say, hey, yeah, I'll get behind you. But I'm going to give you some capital to go do an acquisition, but I want 20% of your business and ownership. Or I'm going to give you $2 million bucks to do an acquisition, but you're going to pay me 15% interest annually, right?
Right.
It's another resource and capital above and beyond the traditional bank. But again, most people in the audience, right, that've been in this landscape world and they're growing and scaling, they know their local banker. They don't have access or resource to that private debt world or those private investors that, hey, I got a $50 million net worth and I like to invest in companies like K&D, right? And help scale. Okay. So one is traditional debt. Okay. Traditional lending. And there's two types of traditional lending, conventional and SBA. And the gating item is always what? Collateral, in my opinion. Okay. Second is, who do you know that's got assets and resources? And can you convince them to loan you money? Because what's the issue? If you have a bank relationship, the bank's typically in first position on all the assets that you own. So if I'm a successful entrepreneur that is interested in lending you money or being a partner with you, I don't really have any collateral because it's all tied up with who? It's tied up with the traditional bank. Okay. Now, this is where it gets fun because over the past 3, 5, 7, 10 years, here's where the new monies come in. And we've heard those terms before. We've heard mezzanine debt or mezz debt lenders, and we've heard private equity.
Yeah, and that's what I want to unpack today. And I wouldn't say, just to back up a minute, on the conventional and the SBA route and the rich uncle route, do you see that there's a lot of the smaller landscape companies and they're hitting that ceiling, whether it's $5, $7, or $10 million ceiling, and they just can't quite grow any further? They're kind of running out of cash, and they're really, really concerned about taking on more debt. They almost avoid the thing. And probably, I would assume, talking from experience with my dad, it was the collateral that we'd have to put up.
Yeah.
You'd have to put everything on the line to get some capital and get some cash to get to the next point.
Yeah, and one of the things that's interesting in the world of institutional money.
Okay.
Right?
Yeah.
Meaning it's not your money and you haven't signed all these personal guarantees. In the world of institutional capital, your neck isn't on the line. You have fiduciary responsibilities, okay? But, your house isn't up.
Right.
Right. And so, what gets fun and what's really fueled the growth in the landscape and green industry has been this institutional capital concept. And what's been fun is, when we were coming up as young guys, right? Most of the institutional money didn't know about the green industry or wouldn't really get involved in the green industry from a size perspective. And then they figured out what the audience knows and what you and I know is like, wow, this is an unbelievable industry.
Yeah.
Reoccurring revenue, right? The opportunity to add technology, the opportunity to teach leadership, the opportunity to grow and scale recruiting and HR, right? And that's the perfect recipe, right, for private equity. So, I think it's important for the audience that we really define what mezzanine debt is and really define what private equity means. And then we can kind of pivot and get into buy and build. And we can get into how come I see all these press releases of deals getting done? And remember, we're negotiating them in front row seat. And then last, like, how do we jump into what's the formula? What's the playbook for value creation, right?
Yeah.
Because it's out there. And what's cool about what you and I kind of see every day in the industry is when you access institutional capital, to me, I think it's the super highway to wealth. It's a super highway to multi-generational wealth. And if I'm running a landscape business doing like 3, 5, 7, maybe even 10 million bucks, and you got these two guys on a podcast talking about legacy and institutional wealth, they say, well, I don't believe that.
Right.
I'm here to tell you, I got a front row seat every day.
Yeah.
Why not you?
Yeah.
Right? Why not you? Make sense?
It makes sense. And that's why I'm so excited to have you here, because you do get a front row seat. And for those who know Pre-PG and your team, your guys' name is attached to a lot of these press releases that go out, whether that's public knowledge or not. We're going to stay off that in specific names, but I'm sure you guys watching this know. And if you don't, you can do some research and find out just how successful you guys have been helping landscapers achieve generational wealth. So why don't we unpack that? Why don't we unpack private equity and this idea of mezz debt, which I think is maybe a new term to a lot of people watching.
It is.
And take that on and start that in any direction and agenda you want.
Yeah. So if we focus on mezzanine debt, the best way to describe mezz debt, in my opinion, and this is my definition, and remember, I grew up on a dairy farm, right? So this is my definition. Mezz debt is this: there are professional organizations that are not traditional banks that lend money. Okay, there's organizations that lend money under a private debt concept. They lend money under mezz debt. To me, mezz debt is this: if I'm going to loan you $5 million to do acquisitions, now you got to be of certain size and scale for me to loan you that money. What I'm going to do is I'm going to loan you $5 million, and instead of you making principal and interest payments to me every month, just like you do on a truck loan or just like you do on your mortgage for your house, okay, I'm going to be flexible with you in the terms at which you pay that money back. Okay. So on my $5 million, we're going to be more flexible in payment terms. Now, because I'm taking a little more risk, I'm going to charge you a higher interest rate. But again, I'm not necessarily going to charge you an interest rate and require you to make a payment every month. Okay.
Okay.
And so if we're in this $5 million arrangement together, we're going to have interest that is accruing essentially, right? And then I'm going to say or negotiate with you, look, I know you're building a business to scale, and I know that there's going to come a point in the near future that you're going to transact, you're going to partner, okay, with some institutional investors. And when you do that, I want a piece of the pie. So we're going to work out an arrangement that says, I'm going to give you $5 million. You're going to go grow and do acquisitions. Okay. When it comes time that you need to pay me back, you're going to pay me back principal and interest on a certain dollar amount. And then there's going to be a certain dollar amount that's going to convert to ownership. So if I give you 5, you're going to pay me back 2 with interest, et cetera, or 3, but 2 or 3 is going to convert to ownership. And now I'm an owner with you when what? When you transact. I have a 20% piece of your pie when you transact with private equity or institutional money. And what that creates is what? Return, right? Not only do I get a higher interest rate, I also get what? A piece of the pie, and there's leverage and scale in having a piece of the pie when you transact with private equity. So what's interesting is a lot of mezz debt is used by private equity companies. So it's very common.
In the door.
Correct.
Yeah.
So, and we'll get into PE, but
Okay.
but remember when interest rates were like 2-3%?
Yeah.
And you could go down to your traditional bank and borrow money, even if you were a landscaper, right?
Right.
And then what happened? Rates started going up and inflation started hitting. So mezz debt was kind of quiet because you could go to your traditional bank and they were pretty liberal with money that they would lend you.
Mm-hmm.
Now we come back and it's like, oh, it's a little tougher. Last couple of years have been tougher to borrow money.
It has.
Right. So the mezz debt guys have really done well there. So traditional debt,
Okay.
conventional SBA, rich uncle, private debt, okay, mezz debt, and then boom, here we are. The biggest buzzword in the industry for ever is what is private equity,
Right.
right? Because everybody thinks they want to do private equity. Some people are positive on it. Some people are negative, but we're seeing a lot of deals, right?
Yeah.
A lot of deals that are backed by PE. So let's talk about what private equity really is, okay?
Let's dive in.
All right, first, there are professional organizations that are in the business of raising capital. Okay. And if I am the founder of a PE group, PE, in my opinion, is just like landscaping. Smaller organizations, regional organizations, national organizations, international organizations. So just like landscaping, small, medium, large, big, PE's built the same way. There are family offices that would be comparable to an operator doing $1 million of revenue, smaller business. Okay. So there are professional organizations, private equity groups. They go out to wealthy families, wealthy individuals, insurance companies, pension plans and endowments, and other institutions. And they say, look, we're putting together either a strategy or we're putting together a fund, and we want you to put some money into our investment. So let's start with the fund concept. Okay. You have investments personally, correct?
Right.
You've put money in mutual funds before.
Yep.
Okay. So think of it this way. Instead of you putting money into Vanguard mutual fund and you go buy Apple and Google and Chevron, right? And whatever they buy in that mutual fund. What if we're private equity investors together and we've gone to those types of families, institutions, and we're raising $400 million? Okay. We're getting $400 million into a fund. And instead of buying Apple and Google and Chevron, we're going to go buy and invest in closely held companies, and we're going to grow and scale, a thesis or a business. And oftentimes guys that raise funds, they don't just buy landscape maintenance companies or tree care companies or turf care companies. They buy lots of different types of businesses. But the goal is this. I've said to you, invest money in this fund, and you've put $5 million in the fund. Okay. Your expectation is this of me, right? Because I gotta prove to you that I'm a good risk, I'm a good PE shop, and that I can get you a return on your money. You give me $5 million. I want to deliver back to you $10 to $15 million over a 5 to 7 year time horizon. So it's a 200 or 300% return on your money. Okay. And the way that we're going to do that is we're going to take your funds along with other investors. We're going to put some debt on it. So if I raise $400 million, I really, with debt, probably have $800 million to deploy.
Okay.
Right. And again, it could be $100 million. It could be $50 million.
Right. Now, numbers all scale.
Yeah. Just put a few zeros or take some zeros off. The concept's the same. And I don't want to, there's times when you talk to an audience and it's like, I just want to make $1 million. I want to make $100,000. Right. But bear with me with the concept. Right. So I've raised $100 million and I now need to go deploy that capital because the people that I've said, give me some money, they want a 200 or 300% return back on their money. And by the way, it's happening every day. We've seen 200, 300, 500, 700% returns in this industry.
Wow.
Okay.
And that's the stuff you don't see in the news.
No, and nobody's talking about it. Like to some degree, it's like, yeah, I think you're full of crap. No, it's real. Right. Now, it's not easy. We'll get into that in a minute. So we've put money together, right? We've raised a fund and we're going out and we're buying landscape maintenance and enhancement companies. And the goal is to the investor. And remember, you got your investor hat on. I've gave you $5 million, Jeff. I want to get a return on my money, right? And you're an investor. You're not an operator, right? So what we've seen in the industry is we've seen all this capital come in. And in the private equity world, you have groups that raise funds. You also have groups that raise dollars for a particular strategy. We're going to go acquire turf care companies and we're going to raise $150 million.
And that's more of a thesis.
Yeah. And what happens there is they go to their investors and they're raising capital, not in a fund where they're going to buy landscape companies and an engineering business and a software company. They've raised funds just to do a turf care buy and build. Okay. and we need $150 million to do it. We're going to put some debt on it, et cetera. You make sense? So private equity, one of the things my team always vets is when we talk to different PE shops, we're saying to ourselves, are they big, small, medium? How big are they? That's number one. Number two is how much capital have they raised? Okay. Number three is, well, how have you raised capital? Are you LP, limited partner based with investors, or are you fund based? Right. And so we're taking all those data points in, right? So come all the way back. What is private equity looking to do? They're looking to deploy investor capital and then deliver a return on that investor capital. And those returns are typically better than the S&P 500, what you can get in a bond fund, a CD, a treasury, et cetera.
Yeah.
Makes sense?
Yeah, they're trying to give you the best return for your money.
Correct.
On the market available.
Correct. So fast forward, we now have capital together. Congratulations. Now here's what's scary. And this is the biggest difference, Justin, with the entrepreneur versus the institutional investor. Okay, drum roll. We ready?
Right.
If you and I own a business and we're building one customer at a time, one employee at a time, and we're working with the traditional bank, and everything that we do, we take personal liability, right? It's based on our personal financial statement. You don't have to spend and invest money, do you?
Now you
look at it. Yeah, you say, "Hey, I'm doing good, but I don't know that I want to take on more risk.
Yeah.
I don't know that I'm ready to jump in and make that commitment to my people, or that commitment to a new piece of technology, or that commitment to more iron. We're going to go all electric, right? I don't know that I want to make that commitment because I'm spending my money,
right?
And I'm trying to build my little nest egg over here, my own little empire, right? That's the traditional entrepreneur, okay? The institutional investor just said, what? I just raised $50 million. I've gone to Justin, I've gone to institutions, and I've said, give me capital, right? I want to create a t-shirt. We're going to do that as part of the Disruptors. We're going to have this t-shirt.
Yeah.
When you raise capital, you must deploy the capital.
You've got to get it out.
When you raise capital, so what that means is I have money to invest. I've promised investors like you that I'm going to invest it. I got to go buy companies, flat out. And you know what the gating item is? It's not that I have capital. The gating item is I can't find enough companies that are of size and scale to invest in. I can't find a good enough company that's got a CEO and a leader that I say, wow, I want to get involved with them because I think we can go 5X the business together.
Right.
I can't find a company that's really all in with culture, right? We're going to do a different podcast one time on what I call fake culture. Okay. You know how there's fake news, right? Yeah, politics. I got fake culture. That's the topic. Stay tuned. But we're gonna step back and we're gonna say, all right, we're ready to deploy that capital,
right?
And the biggest gating item is I want to invest in people. I want to invest in certain markets, and then I want to go out and I want to 5X the business. And in order to 5X the business, I need in our landscape world, I need retention, I need organic growth, and I need to be able to acquire.
Right.
Right. Because I want to take a business that's doing 1 million in EBITDA, or 500 in EBITDA, or 3 million in EBITDA, or 10 million in EBITDA, and I want to grow it through acquisition and organic growth. So if I start at 2 million, I'm trying to get to 10 to 15 million. Well, if I do it one employee at a time, one customer at a time, it takes me 30 years.
Takes a while, yeah.
Right? We want to do it in 5 to 7.
Right.
So the way that we do that is we acquire.
So let's back up a minute. And so we're going to go into this idea of acquiring.
Correct.
But what we're talking about here really is we've heard the word platform company, right? So the private equity in this example is selected if let's just say they've raised a fund of 150 million. They've identified a company that they believe is a platform company, and they are going to purchase that company and convince the CEO and the owner to roll their equity into the next move. And then that's where we're headed. We're headed into what happens after that transaction to go and do acquisitions to 5X.
Yeah, it's buy and build.
The buy and build.
Buy and build strategy. Right.
Yeah, so if someone's thinking about doing this, we've opened up the door to a few different debt facilities and opportunities, and private equity being one of them. As we go into the buy and build, and the guys who are thinking, well, I'm not really ready to take on private equity yet, but I like the idea of buying and building. Is there a pathway there? Is there a road?
Yeah, you do it with debt.
Okay.
You do it with owner finance and deal structure, right?
Right.
So it still starts with, number one, a leadership team that believes that they can go execute.
Yeah.
Right. A leadership team that's humble in their approach, that it's not easy. But how many industry things do we go to, and everybody talks about how it's hard, man.
Yeah.
It's really hard. It's hard to find the right investment. It's hard to integrate. It's hard to put in new systems, hold culture together. It's hard, right? But you still come back to just that simple part of this premise. And I hate the term like sell your business.
Right.
Right. Like, to me, I'm going to sell my business and I'm going to retire and be done. Most of what we're seeing with access to capital and growth is exactly that. It's a vehicle for growth. It's a way to scale. And if you come back to, hey, I'm a sharp guy or gal, and I think I got a good business and I want to grow outside of people and technology, I need capital. And most folks in our industry, they just go talk to their local bank, and they don't have a rich uncle.
Right.
They don't understand mezz debt, and they hear a lot about PE, but they really don't understand what private equity is and how it works. Okay. And it's just like getting married. You got to pick the right girl, right? Like, you got to step back, and it's hard to say, yeah, I'm going to jump in with a PE group when you don't understand PE. Like, there's a checklist, there's a process, right? Mm-hmm. But what's happened in the industry, and our group, we'll do 14 deals this year.
Wow.
14 deals this year. We've done almost $1 billion in purchase price, and we have a bigger Rolodex now of investors saying, what? I'm looking for talented entrepreneurs that have a business of certain size, okay, that are bought into, if I put $1 in, let's go acquire, let's go integrate, let's be smart with organic growth and retention, and let's grow our business to a level that we can access capital. And this isn't my saying, but I want to share this with you, and then we can pivot to buy and build. Okay. So who are the two most wealthiest guys in the country right now?
Right now, probably Warren Buffett, Elon Musk.
Okay. Great. Elon Musk.
Yeah.
Right. And Jeff Bezos. Amazon.
Yep.
Okay. So here's what's interesting.
Yes.
And this is a little bit of a tangent, but it's a good way to wrap this first section.
Okay. Perfect. So stick with
So you look at those two guys, okay, multi-billionaires, right? When I talk to entrepreneurs and even some consultants in the industry, and you start talking about institutional capital in this super highway to growth and wealth, one, they at times don't believe it. And then two, they give me this statement. Yeah, but you lose control. Yeah, you can be fired. You can lose control. It could go bad. Well, listen, I get hit by a bus tomorrow, knock on wood, struck by lightning, right? COVID, are you going to stay in your house, right? Like all those. Of course, there's risk out there, right? But if you look at Musk and you look at Bezos, they've created wealth by owning just a piece of a business, not the whole thing. Right. And we're talking, if it's important, defining how much is enough. My mom is moving towards 79. Jeffrey, how much is enough? And you and I've had this conversation.
Right.
It moves.
Yeah.
Right? But if you go back to this concept of, I have to own it, I have to control it, and I want to grow one customer at a time, one employee at a time for 30 years, we're supportive of that. Right? Yeah. But there is another path, using different strategy and different capital resources to say, hey, liquidity event, put X millions in the bank. I'm going to do it again. Liquidity event, put X millions in the bank. Liquidity event. And typically, I can't have multiple liquidity events, 3 or 4 in your lifetime, if you're just this guy saying, I got to own and control everything.
Yeah.
And you look at Elon Musk and Bezos, right? They don't have controlling interest, right?
Now they own a very small fractional piece.
Correct.
Single digits.
Correct. But for some reason within the green industry and the landscape industry, And look, I get that you can protect yourself with legalities. You got to pick the right partner, right?
Yep.
But you can vet that, right? And there's good groups, just like there's really bad cardiologists and orthopedics. There's really bad PE groups.
Good landscapers, bad
There is, but that's business.
Yeah.
So for you and I, what you and I would challenge the audience with is, why not you, right? And if it's happening every day in the industry, why aren't people educating? And we're doing that, right? That's saying, hey, there's some other paths to go. Let's hop on and educate ourselves around capital and growth and scale. And then look in the mirror and say, hey, do I really believe I can go do it? And by the way, there's a ton of resources out there, including the Disruptors, right?
Yeah.
To help them do that, right? So I get a little fired up about it, right? And I love to get in a room where people say, PE doesn't work, or it was a bad result. And I'm like, what are you talking about? Do I want to have a 30-year career to make $1 million or $10 million bucks, or do I want to do it in a shorter time horizon, right? If I do what? If I'm educated, I got the right people around me, and I pick the right partners. It's happening every day. And that's what's fun. It's been good for our business.
Oh, yeah. So as we wrap this up, guys, I want to challenge you all. Why not you? Right? Why hold on to something for 30 years in hopes of having that one hopeful exit that's financially feasible to retire on? And that's what the power of the Disruptors are. It's the power to come together and have these conversations. Jeff is opening our minds up to this other road that is, it's kind of dark. We're not sure what it looks like down there. But guys, there's an opportunity here that is a once in a lifetime, potentially the best time in our industry of the last 50 plus years that we're at the crossroads of. And it's a great time to be a landscaper, and it's a great time to be in the Disruptors.
All right, guys, that is a wrap for today's episode. What a powerful episode with Jeff Harkness. Thank you so much for listening through. I go on to talk about Disruptor stuff here for the next few minutes on the original recording, so I'm going to cut it there and just wrap it up. But you guys, thanks so much for tuning in. Look, from the bottom of my heart, I want to say thank you, because what we're doing here at Trades Talk, what we're doing to raise the bar in the landscape industry, it's all for the betterment of the industry. How can we make this industry better? How can we make it an industry people want to be a part of, people want to come work in, and people can truly, truly create generational wealth at all levels of the company? Thank you for listening. I hope you guys have a great, wonderful rest of your day, rest of your week, and keep crushing it out there. We'll see you guys on Friday for another weekly update right here on Trades Talk. For now, keep raising the bar. We'll see you guys.
Thanks for tuning in to Trades Talk, where the next generation of disruptors comes to raise the bar. If you got value from today's episode, share it with someone in the trades who's ready to level up. For more tools, insights, and community, follow host Justin White and join the movement at jwhitegroup.com.